thanks for coming. This is part of the Bookmap Professional Trader webinar series here. And today we have Brett Steenbarger here. If you don't know him or haven't read some of his books, I would recommend it. I've read 2 or 3 of his books, I believe here. He is a trader, a psychologist, a trader as well, and an author of several books here, as you guys can see. So he has an interest in using historical patterns in the markets to finding an edge, and is a performance coach for portfolio managers and traders at financial institutions. So we're very pleased to have him here, and I'll let Brett take it away.
Okay, well, thank you very much, Bruce. I appreciate the opportunity to be here with everyone and talk about the topic of evaluating our trading and improving ourselves as traders. Okay, so before we get to the first slide, let's just talk about why it's so important to evaluate your trading. I have a blog post on this very topic right now. If you were to go to the Trader Feed site, you can see that. We want to stay on a solid learning curve as traders. Our learning is enhanced when we look at specific aspects of our trading and systematically go about improving those. So we want to not just keep a journal in the sense of writing down what happened during a trading day or a trading week. We want to observe specifically, concretely, what we've done well, what we haven't done so well, and what we are going to do, again, specifically, what we're going to do going forward to continue doing what we did well and to improve what we didn't do so well. So you want each day's trading, each week's trading to become a tool for learning. The way I've often put it is that any day or any week may or may not be positive in absolute P&L, but you want every day, every week to be positive in terms of learning P&L. You want to get something out of your trading, even if the trading hasn't made money that particular period of time. So there are a few ways of becoming more effective in evaluating our trading and moving forward our learning curve that I have learned from successful traders I've worked with. And those are the things I would like to share with you today. And then, like I said, we will open it up for questions and for comments. So let's go to the first slide, because what we're doing is we're breaking trading down into a few component processes. This is very important. You know, when we talk about trading well, we're not just talking about doing one thing. There are a number of actions that contribute to our success as traders. So the first one is idea generation, which means coming up with good ideas, ideas that are worth trading. I work with portfolio managers at a variety of different types of hedge funds, macro hedge funds, equity hedge funds, quant funds, funds with very specialized strategy, fixed income strategies, commodity strategies. So I've had an opportunity to see what the successful folks do differently from the less successful ones. And one striking finding is that the successful traders work with new and different data. In other words, they are not looking at the same things as everyone else. Everyone else is looking at a daily bar chart and is looking at a 200-day moving average. The successful traders I work with are not doing that. They're looking at things that other people literally are not looking at. Now, this is really, really important, because by looking at new and relevant, important information, they are able to generate new and relevant trading ideas. Now, those of you familiar with Bookmap know that one of the things that Bookmap does is introduce new data, new things to look at. So you're looking at order flow in real time, but uniquely, you're looking at that order flow in the context of historical order flow. In other words, you're looking at where bids and offers are now in the market, but you're looking at how that compares to where they have been. Now, when you look at a traditional depth of market display, like the DOM ladder, you're seeing in real time the bids and the offers. That is useful information. And in fact, when I started working with traders in Chicago, that depth of market ladder was the new data. No one else was looking at that. Everyone's looking at bar charts, and looking at order flow was new and different. And that's why the traders were so successful trading on short time frames. Well, now you look at order flow, but you put it into context. So you see where buyers and sellers are coming in or are placing their orders, but you're seeing how that differs from how they've behaved in the recent past. And that gives you some ideas about whether those buyers and sellers are more and less aggressive. Some of you know that I've also worked with something called Market Delta, where you are looking at actual transactions. So you're not looking at the bids and offers, you're looking at transactions and where those occur in the bid offer matrix. So if a 100,000 share lot is transacted, does that occur nearer to the bid price or nearer to the offer price? When we see transactions nearer to the offer prices, buyers are being more aggressive. Nearer to the bid prices, sellers are more aggressive. And over time, you look at every single transaction, and what does that tell you? It tells you over time if buyers are becoming more aggressive, if sellers are becoming more aggressive. Another thing I look at is the NYSE tick, T-I-C-K, the number of upticks versus downticks. I also look at tick measures for the Dow stocks, for NASDAQ stocks. I look at the upticks and downticks for all traded stocks across the listed exchanges. And so that's telling you, is the stock trading on an uptick or downtick? But it's accumulating that over all stocks. That's new information. You can see in real time if upticks are dominating or downticks are dominating. Are buyers more aggressive, sellers more aggressive? That's in real time, and you can see the flows of that information. So much richness of information that you would never, ever get simply by looking at a normal bar chart. So those are examples of working with new data. Networking is also a way we can improve our idea generation. What I mean by networking is connecting with people who themselves are doing unique things, looking at markets in unique ways. When we work closely with others, either on a trading floor, this happens at the teams I work with at SMB, for instance. You have a senior trader leading the team and you have junior traders working with them, but everyone's sharing information. Everyone's sharing trades with everyone else. And you can see how they're thinking, what they're doing, and you can look at the market through different lenses, which helps you generate ideas. But there are many people who are working online in teams, either with individuals or with some trading groups. The Investors Underground, the Traders for a Cause group is one of those. We have groups such as the ones run by Modern Rock that look at very short-term price action and share trade ideas in real time. And that becomes a way of networking with others, a way of interacting, but also a way of observing what other people are doing and how they're doing it to help us generate new ways of looking at markets. Ultimately, what we're doing with new data and with networking is building our creativity. And this is something I talk about in my most recent book, The Trading Psychology 2.0, that markets are always changing. sometimes they're trending. Sometimes they're in a range. Sometimes they're moving up. Sometimes they're moving down. Recently, we've had markets moving down quite a bit and up quite a bit. And so the setups that work are different in different markets. The information that helps us trade effectively will change as markets change. And so we always have to adapt to these market changes. And so when we can look at new data, when we can network with smart people, we build our ability to generate new and different ideas to fit market conditions. And that really is exercising our creativity. The idea of finding an edge and just sticking to that edge through all markets, that is completely false. I don't know any successful trader who actually does that over time. Because markets change, eventually the edges go away and have to be replaced by new ones. And that's where creativity comes in. Next slide. Okay, so creativity is all about generating the idea, right? But once we have an idea that's worth trading, we have to turn that idea into a trade, right? And so that's where position management comes in. I have found a number of successful traders who will establish their positions based on their ideas, but then they will use the short-term price action to trade around those positions. And I'll explain to you in a minute one way I do that. But what they're doing is, and this is a term I hear a lot among the SMB traders, is they're creating cash flow in the trade. In other words, let's say they get long and the market moves their way, they'll take a piece of the position off and harvest some profits. And then the market comes in a bit and they might add to their position. And so they're flowing in and out of their positions, even while they hold some core position for the bigger picture move. Now, that helps the trader psychologically, because in a situation where you're building cash flow, you're making money on these pieces of the position. And let's say some news comes out and the idea doesn't work out and everything reverses and goes back to your entry point, you have harvested some profits. You haven't just made money in the trade and then given it all back. And so psychologically, to ring the cash register with some frequency builds an internal sense of success. And the key is making sure that the core position is large enough to matter if it goes to your target, and to take enough of the profits that will matter if your bigger picture position doesn't go to its target. So you want to make your entries large enough so that you have room to take something off if the trade goes your way. And you want to be rule-based about that. In other words, you'll have a first target, you'll have a second target. So for instance, if I identify a price level, I think a near-term price level, I think we will take out, that might be my first target. We take that out, boom, I take my profits, but there's another piece that runs because I see a second target. Maybe the second target is we're going to rise above the high of the previous day. So the first target might be the high from the overnight trade if I'm trading the futures like the S&P futures. So I think we'll take out based on the order flow, based on the aggressiveness of the buyers, I think we'll take out the overnight high. That's my first target. Second target is the high from the previous day. And so there's some rules I have around that give some structure to the trading. So the position management allows us to be flexible with respect to market conditions, and of course allows us to add to trades if we see them working out. So we may take out that first target and then sellers come in, but the sellers really can't push it below the open. We had a little bit of something like that this morning in the S&P trade. If you follow the futures, we opened strong and then we had a little bit of a pullback, but we couldn't go below the opening price. And so here was a nice, very short-term oversold point where we could put on a position, take out the previous high. So using some short-term indications of overbought and oversold can be helpful in this position management. I use in much of my trading a 2-period RSI. So it's a very short-term overbought oversold indication. And when we are oversold at higher price lows, I want to think about being a buyer. And when we are overbought at lower price highs, I want to think about selling. And so the short-term oscillator becomes a decision support tool for some of that cash flow trading. Next slide. Improving risk management. This is so important, so important, so important. One observation some successful traders have made with me is that a large portion of their total profitability comes from a relative handful of trades or a handful of periods of time in the market. In other words, they have some periods where they really make a good amount of money. And then the majority of periods, they make a little, they lose a little, hopefully they're net positive. And they don't have many periods where they have big losses. And so there's a skew where they have a lot more big winning periods than big losing periods. And when we see traders fail, very often, it's not that their hit rate on trades is so horrible, it's that they have bigger losers than winners. And so we want to be able to break down our trading to see if we are if our average win size is greater than our average loss size, and if we have more winners than losers in our trading. It's not too uncommon that we see someone who has a pretty good hit rate on their trades. They're like 50-50 wins and losses. But again, the losses are larger than the wins. The average loss is greater than the average win, and so they lose money on average. That's a situation where they could improve their risk management. Now, there are two ways of improving risk management. One is they need to be better at setting stops and utilizing stops that keep losses from getting out of hand. That's the usual way traders think about this. But there's another aspect to risk management that's so important, and that I call opportunity management. Many times, the average win size is not much greater, or maybe is smaller than the average loss size, because the trader is cutting their winners short. They're not letting the winners run to those proper targets that we talked about. And so as a result, they are managing risk, but they're not managing opportunity. They're not getting enough big winners. With the traders I work with, at SMB, for example, they have daily loss limits, daily amounts of money that they're allowed to go down, and they size positions so that they're not going to get stopped out on the day. But if they're trading very well, they want to have some winning days that approach that loss limit. In other words, if their loss limit is $5,000 on a day, let's say, they want to have some days where they're making close to 5,000 or more than 5,000. So that's good opportunity management on top of good risk management. And we can measure that on a daily basis by tracking the outcomes of our trades. The SMB folks use a program called TraderView for that purpose. And I have a link to that on my blog post, my most recent blog post, where it spits out all these statistics for you so that you can see if you're getting more of the big wins than the big losses. And finally, we want to reverse engineer those big wins and big losses. In other words, we want to figure out, what did we do well? How did the market set up when we made a good amount of money, so that we can be prepared for the next possibility? And we want to figure out, what did we do wrong? What did we miss in the market? What did we miss in our position management when we took big losses? and we set goals for improving that. So by studying our big winners, studying our big losers, we can do more and more of what works for us, and we can improve on what we haven't done well. Next slide. So up to this point, we've been talking about your processes as a trader, generating ideas, managing positions, managing risk. But there's another side to the equation, and that's managing ourselves. And so if we are evaluating and improving ourselves as traders, we want to evaluate what we are doing, and is what we're doing working for us in our trading. So I talk quite a bit about successful traders having routines for their trading. They have routines in the morning hours for preparing for the market day. They have routines for taking breaks in the trading day when they might not be seeing things well, or when they might be losing their focus and getting a little too involved in the short-term price action. They have a routine for taking breaks, for calming themselves, improving their focus. Many traders use meditation, for instance, for this purpose. They also have personal routines. So these are routines outside of trading that keep them at their best. And so those routines could involve sleeping well, eating well, physical fitness, doing things in relationships that keep them fresh. Those personal routines are every bit as structured as the trading routines, so that we are continually doing the things that keep us at our peak. The idea is to maximize our energy level and our overall psychological well-being. The research in psychology is unanimous in telling us that when we have high levels of well-being, when we have a good amount of happiness and joy, when we have a good amount of fulfillment, when we have a good amount of energy, and when we have a good amount of closeness in our relationships, those four things, we perform better. We have better focus and concentration. We are more creative. We are more productive. And in fact, when we have a good level of overall well-being, we tend to be physically healthier as well.
Brett, thank you very much. We really appreciate it.
Okay, thank you for organizing this.
Okay, all right, everybody, take care.